Hi, my name is Vanessa Hofmeyr. I'm a portfolio manager with Citadel Asset Management and I'm responsible for the equity portfolios. Today I'm going to talk to you about trying to find pockets of value within our domestic equity market. Over the last year, the stock market increased 24% to the end of June, an excellent return. Over the last 2 years, the stock market is up 23% per annum, giving a very strong recovery after our financial crisis in 2008. So incorporating the crisis, you now have had a return of 4.5% per annum over the last 3 years. And the question is, in a market that has had such a strong recovery, what do we do now in terms of valuations and what can our expectations be for the domestic market going forward? Within context, global equity markets remains our preferred asset class, and we do still think that that sector is offering value, having already seen some strong returns. Emerging markets we still think are fairly fully priced, and South Africa within that universe is priced more or less in line with the mean. Again, fully priced conclusion on equity markets. Within South Africa, the investment universe is no longer offering compelling valuation across the asset classes. Cash is yielding 5.5% at the moment, and after taking inflation and taxation into account, it is by no means sufficient and your capital will erode over time. The last 2 decades has been very strong for bond markets, and that sector too is no longer offering value. Within the equity market, our recovery is well underway, and we are expecting a real, albeit moderate, return in the equity market over the next 3 to 5 years. Let's look at the valuations of the equity markets. A year ago, the market was trading on an 18 price-earnings ratio, or PE ratio. Typically, that would be regarded as expensive and a selling opportunity for investors. Yet a year later, we had a 24% return in investments and the PE declined to 15 times. An excellent return and PEs reducing. This can be explained by a very strong recovery in earnings off a particularly low base. So selling at 18 times did not make sense when earnings were at artificially low levels. Earnings have now recovered, and whilst profitability is still expected to improve from here, we are back to more normalized levels. So where is the value in the equity market? Within the broader sectors, we think the resources sector is looking interesting, having lagged somewhat, particularly the diversified minings, including Anglo-American and Billiton. These companies generally have strong balance sheets and strong cash flows. Our underlying managers in our domestic fund, Hofmeyr, have been steadily increasing their exposure to the resources sector, and by the end of June, the fund had 33% in the resources stocks. Another interesting sector within the financial market, within the financial sector, is life assurance. Life assurance companies, having been out of favor for a while, are now starting to come back into the portfolios. Our underlying managers selling their old favorites, the banking stocks, to buy life insurance stocks. Life insurance stocks are trading at a significant discount to their fair value. An example like Old Mutual trading at a 40% discount to embedded value, which would be regarded as a very attractive price. Within the industrial market, it's a mixed bag with both very expensive stocks and some interesting opportunities, so their careful stock selection will be crucial to ensure a good return. We believe that another opportunity for individual investors that is overlooked are higher dividend yielding companies. These shares can offer you a far healthier tax-efficient payout than, say, your cash return of below 4%. A well-priced asset with a dividend yield of 5% and the potential to grow in capital must be an attractive alternative to leaving your money on call, bearing in mind that equities do have a much higher risk profile. These companies typically have healthy balance sheets and strong cash flows, are inclined to be more mature, and can therefore also weather the respective storms of the business cycle. Another important fact about high dividend yielding stocks is our research shows that across time, high dividend yielding stocks generate the best returns. You have the benefit of capital appreciation as well as the reinvested dividend back in the market generating excellent returns. Over time, your reinvested dividend will generate somewhere between a third and half of your total returns. While the current dividend yield of the market is not compelling, trading at 2.2% and well below the long-term average of 3.5%, again we are finding pockets of value where we can find high dividend yielding stocks. Some examples include the life assurance sector, a sector that is already attractively priced, generating a dividend yield of somewhere between 3 and 6%. The mobile telecom companies also looking interesting, likes of MTN and Vodacom, also generating high returns. Vodacom has a dividend yield of 5%. British American Tobacco, a dividend yield of 4%, attractive dividend yield, and also remember a high cash generative business, excellent valuations, and rand hedge characteristics. Another company could also include Coronation, which is generating a dividend yield of around 8%. It's important to include a selection of stocks across the sectors so you don't end up having all your eggs in one basket. By investing in quality companies that have strong cash flows, healthy balance sheets, high dividend yields, and generating excellent return will be a good investment over time. We will continue to select value managers that are trying to find these pockets of value within the domestic equity market so that we can ensure a solid and consistent return to your portfolio, ensuring that over time your capital grows and it is not eroded by inflation and taxation. Thank you very much.